I'm going to have Richard Liu of Solarbank come up next.
Great. Thank you, Crystal. And I want to thank ArcStone and Kingswood for this wonderful opportunity. It is my pleasure to be here to share with you another diversified growth opportunity. You could also see it's disruptive for the existing energy world. This is the ecosystem where we deploy about $200 million of capital to build a new energy infrastructure. So as you all understand that how we keep the lights on is there are power generators, get the power into transmission lines, get into the distribution line, and eventually get to the devices, the bulbs here to keep the lights on. So Solarbank as a company that operating in that arena, that where we build a large-scale generation assets that send the power to the grid. And along the way, we currently are building 3 large-scale battery storages for the Ontario grid and a contract with the government for 22 years with a fixed income of $1,500 per megawatts per day, right? Then we keep going to the distribution area. In the United States, we are building community solars where we sell electricity to participants at a discount to the retail price. That brings about $1 million a month of recurring revenue for us. That if you continue in Ontario, we own about 100 of those generating assets under the feed-in tariff contract that we built over the last 10 years. That's another guarantee for our investors' return. We're not only interested in decarbonize the electricity grid, but also we are in the business of decarbonize the transportation business. We're currently building high pressure, high voltage DC EV chargers with Walmart, starting from Vancouver and across the country. So if you look at this one, is that we have a very good ecosystem here that we can sell the electricity at wholesale, at the retail, or whether we turn them into molecules as hydrogen for the hydrogen EVs, or we just sell the electrons at a much higher price at the EV charger. So that's the ecosystem that we operate. The company being existed for more than 10 years. I'm the founder, president, CEO of the company. And you can see that we have always been kept revenue positive, profitable from day one. We did not take any angel money, VC money, PE money, all the way till we went public in the CSE, then quickly become Cboe, and then now we are in NASDAQ global market in New York, right? We have a very simple business process, which is production-based, that we start from original site control, which is really leasing the sites for 35 years. With that in hand, we already, by that time, already know there's a policy support from local government. There's also a financial model that can give the business a more than 10% return, which is about 1 or 2% than your utility regulated return. I'm 34 years in Toronto, worked for Husky, Enbridge, Toronto Hydro, and so have a pretty good understanding of what the return that you will get. You know, if you specifically look at electricity, everyone generating electricity, if you're using fossil fuels, you have to pay for the fuel. That's about the 30–40% is gone. We don't pay for the light. We get the fuel for free. At the end of the day, when electricity is generated, sent to the customers, that usually people will have to be subject to carbon cap, carbon taxes. We don't pay carbon tax. We actually sell our carbon credits. So from beginning, the design of this business, already 40–50% from a cost perspective ahead anyone else producing electricity, right? So from there, we secure the site, we secure permit. We are an engineering firm. We're licensed in Ontario, in Alberta, in Nova Scotia, and also we have partners in the States, which is our main market, that we do the engineering, procurement, construction. So for us, this is a production line the project is going through. At the end of the day, when we finish it for ourselves, because we do own those assets, or we finish it for Fortune 500 companies such as Honeywell, we earn operation maintenance fee for 35 years, right? So now through this end-to-end process that we deliver an investment opportunity for our investors that are interested in long-term sustainable competitive return and also fulfill their obligation, desire, or liking to be part of the solution for the climate change, global warming, and all those parts, right? We participate in 3 of the 4 market segments. We do a lot of behind-the-meter one with Fiora, a $7 billion company with Home Depot. You see a lot of rooftop things. Most of them are ours because we have about 50% of the Ontario feed-in tariff market. We do a large deal of community solar in the States, and we have about 10,000+ customers now, operated through our 2 call centers, one in Boston, one in Chicago. And of course, we have large-scale development in Nova Scotia, in Ontario, in Alberta, in California, in Nevada, and in Arizona, right? If you look at this business, we've been in the market for more than 10 years. Our business are mainly grown organically for the last decade, right? We're currently finishing, you will see our annual financial reporting Monday. We did, I think we overshot our initial market forecast of $50 million, and I think we're close to $60 million of revenue this year. We are currently have about 138 megawatts in the production line ready to construct. If you times 1.5, that will be basically potential revenue we're going forward, right? If you look at the overall process that we could do this organically, but because of the recent changes in high cost of debt and also because of the high cost of labor and other disruption in supply chain, all those areas, that there are a lot of companies running out of cash, right? We cash rich, right? When they run out of cash, what they do, they will sell their project, right? Because they borrow the money to develop project. We don't. We have our own income from operations to support the development. So we did pick up quite a few mergers acquisition opportunities, the latest being a $45 million all-stock deal acquired solar flow-through fund in Canada. That's the foundation of our independent power producer business, right? Looking forward, if you say, what this company will look like in the next 3 to 5 years, I would say that this company will continue to focus in North American, Canada, and the US. You will see us have traditional revenues by selling project, earning a development fee, which is margin is about 70-75%, that we will build for credit customers such as Honeywell, Walmart, or Charlie's Philly cheesesteak. I think they have 1,000 restaurants in the States that we are partnered with them for since 2017. That will give us I would say, at or above market construction earnings, and we're also operating those assets, about 100+ of them now, and it's increasing, and that's operation revenue with a margin of about, I would say, 70%. Right, so that's where our traditional income, and the start of the 2023, 2022 actually, we start to own those assets. That current recurring revenue for this company is about $12 million a year. It's growing, and the target is the same as about $100 million in the next 3 to 5 years, right? For us, if you look at the policy support, because of the Inflation Reduction Act, because of the investment tax credit, and the interest rate is dropping also. So for $1 billion asset, we will have about $500 million long-term debt, which we took quite some long-term debt over the last 10 years, have a very good supply of long-term debt. Will, through the transferability of investment tax credit, that what we will do, we'll be able to sell our credit for about $350 million. So with about $150 million in the next 3 to 5 years, that we will be able to build and own $1 billion asset will give us $100 million recurring revenue for the next 35 years. And how do I get the $150 million, right? Of course, I will show you our stock is very strong, very stable, but our income from operations, right? is a major part. How do we raise sponsor equity that to keep the company to achieve our $1 billion market cap goal? So this is a current cap table. Most of those shareholders are with me from day one, and all their shares and options are subject to 3 years of resale restrictions, and they are very, very patient, high net worth individual investors. So far, we have about 4,000 shareholders, about a dozen of, I would say, institutional investors. And the good thing is that we are known to patient money. Okay? The team is very stable. As you can see, we built this company from a production perspective, from development, engineering, procurement, construction, operation, maintenance, and asset management. So Tracy is our head of development. Her team will bring project from secure a site, give it a landfill site, brownfield site, non-productive surfaces to full permitting, then hand it over to Chief Operating Officer Andrew. He himself is an engineer, and his team of engineers will design them. We procure it from the market. Our procurement actually are very, very simple forward. From there, we build them and operating them. And Sam is the CFO, making sure there's always cash to support it. So this is the last slide I want to share with you. On your left is the Canadian stock performance that we went to the market at 75 cents. And over the year and a half, we were able to go up. Instead of going down, we're actually been going sideways because we do have product going to the market on a regular basis. That if you're looking at the right, that's on the NASDAQ global market. And we did have a lot of pressure, downward pressure. I think that's the main reason is because I've been sharing the stories with people like yourself, that our people believe that I'm desperate needing money and looking for a discount. I can happily tell you we have a great cash reserve for operations. Yes, we do looking for money to own asset, but those money will only take from people in this for the long run. So I guess after, I think, Kevin, probably after a few months, realized we're not taking money from market. I think people borrowed all the shares to short us at 18% interest rate. I think a few days ago, they had enough, they let go, so that's where going back. Even the guy in the short business, this is Simply Wall Street, and he published this about it yesterday or 2 days ago, saying this one is severely undervalued, about 41%. So for that, I want to share with you that this business is a safe, reliable, low-cost, sustainable income that not only you will make money, but also you can change the world by get away from using fossil fuel-based electricity. So I will stop here. I know I'm perfect on time. I guess I'm minutes already. Yes, Cameron.
Richard, question for you in terms of your revenue mix, in terms of the four.
You had a slide up there that talked about your growth strategy, and you had 4 different things that you were focused on: EPC, O&M, development. I think it was
ownership.
IP. Right.
Yeah.
So in terms of the mix,
Yeah.
like I'm not going to ask you percentages, but like moving forward, does that mix change significantly in terms of how your revenues are generated?
Yeah. So the question is about our revenue mix and what's the future strategy to grow the company. We started as a developer, which is to bring a project, from a vacant piece of property to full permitting. That one, our gross margin is about 75%. So from that revenue alone, more than enough income to keep the company going. Then our major revenue is from the engineering procurement contract. We don't build for others. We don't allow others to build for us. We have our own, we're always the general contractor. That income from operations is used to expand the business. Then operation maintenance was a high gross margin. So now we have enough income from operations. We're focusing on ownership. So you probably will see next year the revenue will be more or less the same as this year. The reason is not because we lack of business, because we're keeping it, right? So obviously, if you're keeping it, you cannot count it for revenue. So, thank you. I'm around, so if there's any questions.
Yes, absolutely.
Thank you, Crystal. Thank you.
Thank you. Thank you so much.